Hello, this is Chad Frantzen, CEO and founder of Authentic Counsel and a certified financial planner. In today's video, we're going to be providing our October market outlook, and I'm going to be sharing our presentation slide here as we go through it. For more information about the financial planning services and investment management services we offer, please visit us at AuthenticCounsel.com. Let's jump right into some charts. Again, the markets have continued to prove to be resilient as we enter the fourth quarter of 2020, which has been a year like no other. This chart here shows that the environment that we will be in for the foreseeable future is one that is a low interest rate environment. So the Federal Reserve is the organizational body that sets prevailing interest rates for us, which most of the world follows. And you just see on this chart, since the outbreak of COVID, when rates were dropped to zero, we do anticipate that the Federal Reserve government will most likely, based on its comments year to date, continue to keep these interest rates near zero for the foreseeable future. Now, what that means is that for refinancing of mortgages, it is opportunistic. What it means also is that it is much more difficult for you to earn historically average rates of return on money market accounts, CDs, bonds, things of that nature. So keeping the target rate lower by the Federal Reserve is really in an effort to help prop up the economy and to get the economy back going. But a lot of questions we get is how long do we think interest rates will stay low? And we do anticipate that that is for the next couple of years. This next chart is on the U.S. economic growth. Economic growth is measured by something called GDP, which stands for Gross Domestic Product. And as you'll see here, back in the 2008 to 2009 and 10 recession, the GDP, which is whether the economy is growing, if it's above this line here, it's growing, expanding, or if it's below this line, it is in what we call recession or contraction. So the recession low back in 2009 was negative 8.4%. We know with the year that has been 2020 with COVID-19 that it went as far down as negative 31%. And on the following chart, we'll kind of show our expectations for that as the economy slowly works its way out from pandemic impact. This chart here really shows that most research seems to indicate that the forecast for how quickly the economy will come back is going to be very, very slowly. On the previous chart, we showed that it was a very low negative. For the third quarter and the fourth quarter of 2020, as well as into the second quarter of 2021, it is forecasted that the economy will still be in a drawdown or a contraction period for that. And that forecasting right now, it could well be this time next year, that is the fourth quarter of 2021, before we see the economy get back to level, to get back to where it's potentially in an expanding mode. Now, that being said, the reason why we look at this is that the markets are predictive factors. The markets, whether it's stock market, bond market, commodity market, interest rate markets, they're looking to discount future events, whether that's the election, whether that's the economy, whether that's how quickly we'll have a vaccine for COVID and so forth. So right now we do expect that the economy is slowly gonna work its way back through the end of next year before we see it back to pre-2020 levels. Many of us most likely know small business owners or individuals who have been affected by the loss of employment during this most difficult year. And we'll see here on this chart that indicates that this is still a major underlying problem of unemployment. This is a chart that shows unemployment going back to 1960 from the Bureau of Labor Statistics. So still very high unemployment. And one of the more alarming things is we're seeing large corporations doing okay. Some of them, depending on what industry they're in, actually gaining market share. But what we're seeing is, as this slide illustrates, is small businesses are having the most difficult time. So as you might expect, many small business owners in these types of industries are having to close their doors, lay off people, and are not even able to pay their rent as of October. This was from a survey of a little over 7,700 small businesses that were surveyed. So everything from beauty salons to restaurants to fitness centers, consumer retail, all the way down to even legal and health and wellness. A large percentage of these small businesses are not able to make ends meet when it comes to paying their rent and paying their employees. So this is troubling. A large part of the economy is small business as well as consumer spending. So this is something that's a major headwind for us in the U.S. as the economy continues to try and find its footing during this pandemic and the aftermath of it. Switching now to just valuations in the capital markets. This chart here shows three different high-level markets: the United States market, which we have here based on the S&P 500, which is the 500 largest publicly traded U.S. companies. And we also have the international index, which we call the developed markets. And then we have emerging markets, which are emerging, smaller countries, emerging markets for that. Now, not to get too deep into technicals, but PE ratio stands for price to earnings ratio. So what this chart tells us is how expensive or inexpensive public equities are in the U.S., internationally, and in emerging markets. So the numbers here: 20.9x, 17.1x, 14.3x. That means that the price to earnings ratio is at 20 times, a PE of 20 for public U.S. equities, as you can see if you follow this chart, is historically very high. Now, comparatively, in developed and emerging markets, the valuations are high. They're on the expensive side, but they're not as high as the United States. In fact, emerging markets actually have some potential value here because their valuations are not as high as what we're seeing in developed countries and in the United States. All that just tells us that we certainly have markets, capital markets, particularly public stocks, that are highly valued based on their earnings, and certainly given the ongoing economic uncertainty, both U.S. and abroad, tends to give us pause as to buying certain public securities at such a high price. Going on with that point, this chart is an asset class total returns. This is through the third quarter of 2020, and this is just looking back over the last 15 years. What we will observe from this, there's a lot of information here, but for purposes of this presentation, what's done well this year: fixed income has done well, bonds, and then surprisingly enough, the S&P 500 has proven to be quite resilient as it's bounced back from the lows in March and April to have a positive, around a 5% positive rate of return for the year. Small caps, international commodities have all had negative rates of returns through this year. So all in all, very volatile market. We've seen certainly a lot of the large cap technology names help drive the U.S. markets to back to very high levels. And this chart just shows that visually. Since the coronavirus epidemic, the markets spiked down dramatically. And around the end of March, early April, they've just slowly, with volatility, continued to work their way up to where, right now the S&P 500 is up 4 to 5% year to date. That does give us some concern just with how high these levels are. which we'll share a little bit of our thoughts here at the end just on how we're managing portfolios for that. But given these high valuations in the markets, it is important to just recognize where we are with respect to the economy and just a lot of the geopolitical issues that we have going on and what the stock market is telling us. So again, 20 times earnings, that's very expensive. The tech bubble, when it peaked in 1999, 2000, was around 24 times. So, we're not quite to that level, but certainly, as you'll see, when the financial crisis was at its low in 2009, stocks as a whole, public securities, were selling for about 9 times their earnings. The historical average, depending on the formula you use, is somewhere around 14 to 15 times. So if we use this red line as a barometer, you can see clearly that, when the COVID virus broke out, you can see that the market went below its historical average. And there was some opportunities here to be buying things if you had long-term money and you had a risk tolerance level for that. But because of just the surge that we've seen, we really feel like the markets are due for correction, for a pullback. It is certainly historically not sustainable that the stock market can be at over 20 times earnings. So to conclude this October market update presentation from Authentic Counsel, thanks for joining us. Just a few points here. Some of these are a continue over from past observations. We do see current market valuations are at extreme levels. They do tend to be divorced from some of the realities of the economy and the impact that the pandemic is having on families and small businesses and employment. Now, that being said, we do think the likelihood of a recession seems less likely than it did a few months ago, but we do feel like this is going to be a very drawn out economic recovery. Given that we're in an election year, in a highly contended for and contentious election cycle, with the presidential election just a few weeks away, we would expect volatility to continue. Excuse me. Finally, it's always important as investors to revisit your comfort level with your investments to make sure, what type of risk management do you have in place? As a certified financial planner, we work with families just to review that. So we think that's really important to review your risk management techniques and strategies. And then also we would consider how much you're investing into your accounts. For example, if you're contributing to 401ks or IRAs or brokerage accounts, make sure your budget is in line with that. If you're withdrawing money from a retirement account, we recommend you evaluate that as well to confirm that you're taking out an appropriate amount, somewhere in that 3 to 5% annual rate of withdrawal. Is statistically long-term viable. Much more than that, and you're probably going to be dipping into principal. With respect to the portfolios that we manage at Authentic Counsel with our research team and investment committee, what we have been doing going into the fourth quarter and into the end of 2020 is we've been raising cash. The markets, we've been able to participate in the market recovery to where most of our portfolios all have nice positive gains for the year. And really, we think that the election will probably be unresolved well past November 3rd with a recount or who knows what's going to happen there. So the uncertainty of that and just, the potential for ongoing issues with COVID and flu season, we've made the decision within our model portfolios, conservative, moderate, and aggressive, we're just going to raise cash to protect capital, implement some risk management there, and then just evaluate what the landscape will be going into 2021. There are some different investments we're really excited about that we think present some great opportunities for us, both in the public and private markets, that we'll be visiting with our clients on as we continue doing research on those. So that's a summary. Again, this presentation just represents the opinion of our firm, Authentic Counsel. We do recommend that you consult with a financial advisor or certified financial planner to get specific advice for your firm. on that. Again, this is Chad Frantzen with Authentic Counsel. For more information about our services, if you'd like to learn how to apply the principles that we teach and promote to your financial well-being, please visit us at AuthenticCounsel.com. And again, this market report is for as of October 5th, 2020. And thank you again for joining us. So we wish you well, stay safe, and we'll see you next time.